Okay, so Fed Chairman Jerome Powell highlighted that elevated geopolitical tensions following the conflict in the Middle East. So how significant is this the factors that could change the Fed policy?
Yeah, I mean, we got to have to remember is that part of the reason inflation has been coming down in the United States and in Europe and elsewhere is that the oil price has sort of stabilized on a year-on-year basis. Energy prices are falling, and that's been an important part of bringing down overall inflation. But of course, that part is sort of out of the control of the Fed. So the fact that we've now got this new upside risk to oil prices coming from the tensions in the Middle East, I think is making central banks, including the Fed, a bit nervous because, if the oil price goes to $100, $120, that's going to put upward pressure on inflation. And a lot of the good work that people think, is maybe down to the Fed, but is really just down to the oil price, that could be very rapidly undone. So I think this is definitely something that makes them even more cautious, making sure that they don't start cutting rates too quickly, they don't peak rates at too low a level.
Okay, so the other risk is China. So Fitch highlight the deepening slump in China property market as a risk for global growth. Is China slowdowns a bigger risk for Asia than U.S. rate hikes?
I think to some extent it's a more immediate issue. The Chinese economy is huge, massive linkages with the region. We're seeing the consumer side come back a little bit stronger now than we were seeing a few months ago. So that's a positive, but still we see lots of negative forces on that economy. China's done very well in the last 2 or 3 years out of the export side, but that's now falling. Export demand is falling. The property sector is showing no signs of stabilizing at all. It's a hugely important sector of the Chinese economy. So we've got growth falling to about 4.5% next year, and there's a downside risk around that forecast. I think that's a bigger issue for the Asian economy, to be honest, than the Fed hikes.
Okay, well, that Fitch revised up is a forecast for world growth in 2023 by 0.1 percentage point to 2.5%, reflecting surprising resilience so far this year in the U.S., Japan, and emerging markets, excluding China. How have these recent developments affected that forecast?
I think it's looking like the US once again is turning out a bit stronger than we thought when we published those forecasts in September. The third quarter numbers, the 4.9% annualized growth, with consumer spending staying strong right through September, means that the economy in the US is going to grow even faster this year than we expected. And as I say, the expectation of a technical recession in the first half of next year. Now I think there's some significant doubts now about whether the US economy will slow that much. And as I say, the Chinese consumer has been looking a little bit better, but we're still concerned about China on the property side and the spillovers from that area. So big picture, slightly better in the near term, but still lots of headwinds for 2024, we think, as the lagged impact of monetary policies takes a stronger hold in the US and Europe.
Okay, what is your view of commodity exporters like Indonesia in dealing with U.S. interest rate policy, plus the concerns triggered by the Russian-Ukrainian war and the Middle East conflict?
Yeah, I mean, obviously, there's a lot of different tensions in the world economy now that are affecting commodity producers. But I think the China slowdown has got to be a big issue. And then there's this broader tightening of global financial conditions. The US 10-year bond yield is an absolutely crucial variable for sort of dollar funding conditions globally. And as those yields have increased and the dollar has strengthened, we've seen negative pressures on currencies in the region. I think that was probably a factor in the recent surprise interest rate hike from Bank Indonesia, the pressure on the currency. So I think it's that currency pressure and how that might affect the monetary policy, the domestic monetary policies in Asia. That's probably the key route from the Fed to the region. And as I say, that's coming in combination with China's slowdown, which naturally will put downward pressure on commodities. So weaker commodities, tighter global dollar financing conditions, and not a great mix, and slower US growth next year, not a great mix for emerging market quality producers, to be honest.
So what is your predictions about the Indonesian's economic growth in the middle of global pressures, in the middle of strength points, the lowest economy in China? We're still can growth so well, do you see in 2024?
We still see underlying growth dynamics as pretty favorable. You know, when Bank Indonesia raises interest rates, you know, it's not a highly indebted domestic economy in Indonesia, so there's not such a big drag from that. So that they're able to focus on the FX stability more, you know, without sort of necessarily weakening domestic growth. I think it's that commodity channel is a headwind, but then we're seeing some pretty decent dynamics in terms of the sort of recovery in the economy and the reopening. So we've had numbers around 5%. You know, that still looks achievable to us.